The strange thing about financial crises is this. Most people feel poorer. A small group quietly walks away richer. Not by luck, not by talent, by structure. Think about the last financial crisis you remember. The panic, the headlines, markets collapsing, jobs vanishing. Everyone was watching the fire. Almost no one was watching what moved in the smoke. Wealth was moving upward. And this matters now because crises aren't rare anymore. They're recurring. Debt cycles snap, bubbles burst, liquidity dries up. Each time we're told it's unexpected. Each time the outcome is familiar. Let's make this simple. Picture the economy as a building. Most people live paycheck to paycheck on the lower floors. Rent is due, bills don't pause. A small group owns the building. They collect rent, they insure it, they have exits. When the building shakes, panic spreads at the bottom. People rush to sell whatever they can. Stocks, homes, small businesses. Not because they want to, because they need cash. This is the first transfer. In a crisis, prices fall fast, and selling is forced at the worst moment. Income stops, but debt doesn't. Now look at the other side. Large investors don't rely on wages. They have reserves, credit lines, time. When panic hits, credit tightens for almost everyone, except the people who already have it. Banks stop lending to small businesses, but governments still borrow. Big corporations still borrow. Large asset holders still borrow. Why? Because in a crisis, safety matters more than return, and the safest borrowers are the ones who already own assets. So while prices are collapsing, they start buying. Stocks at a discount, real estate at a discount, entire companies at a discount. This isn't a conspiracy, it's arithmetic. A 30% market drop hurts everyone on paper, but only one group is forced to sell. Someone with 10 million in assets loses 3 million temporarily. Someone with one income loses everything permanently. Same shock, different survival odds. Now comes the part most people misunderstand. Government intervention. During crises, governments step in to save the economy. Interest rates drop, liquidity floods the system, central banks buy assets. Sounds neutral, even generous. But ask one quiet question. Which prices are being protected? Stock prices, bond prices, housing markets, financial institutions. Not wages, not savings, not job security. New money enters the system through financial markets first. That's how the plumbing works. So assets recover faster than the real economy. Sometimes they hit record highs while layoffs continue. That's not a glitch, that's the mechanism. Losses hit the bottom immediately. Recoveries reward the top first. After 2008, home ownership fell. Asset ownership concentrated. Corporate profits recovered years before wages did. After the pandemic shock, the pattern accelerated. Markets surged. Inflation ate cash savings. The wealth gap widened again. Different crises, same transfer. And here's the uncomfortable truth. This doesn't require evil policymakers. It requires a debt-based system. Debt needs collateral. Collateral is assets. When the system is threatened, it protects collateral, because if asset values collapse too far, credit collapses with them. So stability means protecting wealth holders, even if no one admits that openly. Each crisis cleans out weaker balance sheets. Each recovery lifts asset owners higher. Quietly, legally, predictably. And the public is told the crisis is over because markets look calm again. But for many people, it never really ends. Zoom out far enough and a bigger risk appears. If every crisis transfers wealth upward, trust erodes downward. People don't need to understand the math to feel the outcome. They just notice that the system keeps surviving, while they don't advance. So here's the unresolved question. If every financial crisis keeps making the wealthy stronger, the rest more fragile, and the system more unequal, Is the real danger the next crash, or the moment people realize this is how the system actually works?